Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and today I'm gonna react to a recent video entitled Realty Income is Doomed by the YouTuber Dividend Bull. That title is actually sarcastic because Dividend Bull is bullish on Realty Income, and he even said that he owns a position in O stock. And so in that video, Dividend Bull offers a rebuttal to my recent article entitled Very Bad News for Realty Income, in which I explain why I recently decided to sell my position. He offers some interesting counterpoints, and in today's video I want to go through each of them one by one and offer some additional thoughts. But before that, two things. Firstly, I want to thank Dividend Bull for even mentioning me on his channel. He's a far bigger YouTuber, and so I appreciate the exposure. And while we disagree on some points about Realty Income, I still respect his opinion, and I think that he produces some great content about dividend stocks on his channel, so I encourage you to go check it out. And then secondly, I wanted to let you know that I plan to soon reach out to the management teams of Realty Income, but also some of its close peers, including YCHARTS, NAREIT, Realty, Essential Properties Realty Trust, in order to conduct interviews to offer you even additional context. And so if you don't want to miss out on this, make sure to subscribe to the channel. So with that out of the way, we can get started. And so in my article about Realty Income, I gave 5 reasons why I decided to sell my position, and Dividend Bull offered a counterpoint to each one of them. In my first point, I argued that the recent M&A deals of Realty Income, including the acquisition of REIT as well as Spirit Realty Capital, had lowered the average portfolio quality of Realty Income. Dividend Bull appears to disagree here, and he explains that Realty Income actually spun off the weakest office properties of REIT after having acquired it, and so he seems to imply here that Realty Income was then left with the best assets of REIT and that therefore it didn't lower its average portfolio quality. But the problem here is that it's not just the office properties of REIT that were lower in quality. I think that its retail properties were also below average when compared to the assets of Realty Income. I have followed REIT long enough to know that this company even used to have a different name. It used to be called American Realty Capital, and for most of its history, it was a mismanaged REIT. They were mostly buying riskier, higher cap rate properties in an attempt to manufacture short-term FFO per share growth, and it worked for a while, but eventually they ran into severe tenant difficulties because they were again acquiring subpar properties, and this then even forced the REIT to rebrand as REIT and to change its leadership. They then made some improvements to their portfolio, but at the end of the day, this was still a lower quality REIT, and this explains why it was priced at such a lower multiple than Realty Income and some other net lease REITs. You know, REIT was priced for most of its history at close to 10 times FFO, even when interest rates were very low, and in comparison, REITs like Realty Income were priced at closer to 15 times FFO, Realty as well, and the market may not be perfectly efficient at all time, but obviously if it's pricing a net lease REIT at 10 times FFO and another one at 15 times FFO, probably there is a good reason for it, and in this case it's because it owned a lower quality portfolio. To give you a quick example that now comes to my mind, for a long time Red Lobster used to be one of the biggest tenants of REIT, and today they are likely facing bankruptcy. And the same is true here for Spirit Realty Capital. It's also a net lease REIT that used to focus on riskier, higher cap rate properties, and they ran into severe tenant difficulties, and this even forced them again to spin off some of their weakest assets. They had to change their leadership, they had to change their strategy, and they then made some improvements. That is true, but at the end of the day, it was still lower quality net lease REIT. It was priced at a steep discount to its peer group, and there was a good reason for it. Realty Income was able to nicely expand its FFO per share by acquiring these two REITs because they were priced at such lower multiples, but as a result, it now has integrated these lower quality portfolios as part of its own, and as a result, the average portfolio quality has decreased. Dividend Bull then mentions that Realty Income has a 98.6% average occupancy rate, and he explains that this is way above average for industry standards, but that actually isn't true if you compare the occupancy rate today of Realty Income to that of its close peers, including YCHARTS, NAREIT, Realty, and so on. It's quite a bit lower. The occupancy rate of Realty today is 99.8%, that of YCHARTS is 100%, that of NAREIT is 99.5%, that of Essential Properties Realty Trust, which focuses on riskier properties, even that REIT has a higher occupancy rate at 99.9%. Again, that of Realty Income is 98.6%. That's closer to the low end of the net lease REIT peer group today, and it's reflective of these recent acquisitions. But there are also other metrics that show you that the portfolio quality of Realty Income has come down. Just a few years ago, as an example, it used to generate a far higher percentage of its rental income from investment grade rated tenants, but that percentage has come down quite significantly. And so with that in mind, I don't view Realty Income anymore as a net lease REIT that focuses on the higher quality spectrum of the net lease market. This was true in the past and it justified a premium valuation multiple, but this simply isn't the case anymore. If you now compare it to Agri-Realty as an example, I'll put a table on the screen that I've shared previously. You'll see there that Agri-Realty generates a far higher percentage of its rental income from investment grade rated tenants. It also has higher exposure to safer segments of the net lease market. Its main tenant is also safer. It has a higher percentage of its revenue coming from ground leases, which are even safer than net lease properties. But really there is a pretty significant difference today. Back in the days, I would view Realty Income as a similar REIT as Agri-Realty, but that simply isn't the case anymore. Then my second argument for selling Realty Income was that it had become too big for its own good and that its massive size would hurt its future growth prospects, and as a result it would likely generate lower total returns than many of its peers. Here Dividend Bull argues that on the contrary, that its big size has many advantages. For one, it affords Realty Income a better credit rating. It has an A- credit rating, which is the best in its peer group, which allows it to get lower cost debt. And then secondly, and even more importantly, it seems this affords better diversification across the portfolio, which lowers risk. Dividend Bull is correct here to point that size has some advantages, but where I disagree with him is that I think that these advantages really aren't significant when compared to its close peers like Agri-Realty. And that's despite being a far smaller REIT. Agri-Realty is still large enough to be very well diversified. It has a $5.8 billion market cap, and so past a certain size there really aren't any major additional benefits in incremental diversification. On the contrary, I think that past a certain size, risks start to increase because you cannot be as selective anymore about your acquisitions. You have to acquire a huge amount of properties all the time. So you cannot be as selective. You're going to have to buy some low quality assets just to keep the ball rolling. That's what Realty Income has been doing, as we discussed earlier. On the flip side, if you're very small, you can be very selective. You have strong bargaining power with the property sellers. You can focus on the higher quality properties and that's it. And that's what Agri-Realty is doing. So I really don't think that Realty Income's largest size is lowering risks here. On the contrary, I think it's increasing risks. I would much rather own a $5 billion portfolio of the very best net lease properties, the safest with strong tenants that have investment grade ratings, than a larger portfolio of, let's say, 50 billion with some good but also some average and some bad properties with a lower percentage coming from investment grade rated tenants. Again, there's no real major benefits in incremental diversification past a certain point. And yes, the better credit rating also is an advantage of Realty Income, but you need to remember here that net lease REITs really don't use much debt these days. Their average LTV is about 25 to 30%, so getting a tiny bit lower interest rate really isn't moving the needle here. But on the flip side, the massive size of Realty Income is going to have the disadvantage of likely slowing down its growth going forward. Here, Dividend Bull refers to a table that's available on Seeking Alpha that compares the dividend growth rate of Realty Income to the sector averages, and it shows that Realty Income is above average here. But this actually isn't correct because that table on Seeking Alpha doesn't compare Realty Income to its peer group, which would be Agri-Realty and NAREIT and so on. It's comparing Realty Income to the average of the entire REIT sector, which is full of companies that are completely different from Realty Income, and so that comparison really isn't helpful at all. If you look at the past historic growth of close peers of Realty Income like Essential Properties Realty Trust or Agri-Realty, and you compare that to Realty Income, you would see that Realty Income has been growing slower ever since size became an issue. And more importantly, I think that this difference in growth is only going to grow larger going forward because Realty Income is now bigger than ever. Hey, before I go into the next counterpoint, can you please do me a huge favor and click the like button? That helps me a lot to grow this channel. Thank you so much in advance. Then my third argument for selling Realty Income was that it's losing in focus, and I don't like REITs that aren't specialized in one specific property sector. Dividend Bull appears to agree here that it's typically better for REITs to specialize in something, become expert at it, because you cannot expect to get above average returns by being a jack of all trades. But still, Dividend Bull really isn't concerned about this because he argues that the percentage of revenue that's generated by these specialized assets like casinos, vertical farmings, data centers, and so on is still very small, and so most of the revenue is still coming from Realty Income's main specialty, which is service-oriented net lease properties. And yes, he's correct that these sectors today are still fairly small in the total portfolio of Realty Income, but my concern here is that this percentage is going to grow going forward, and I think that this could hurt the market sentiment of Realty Income. Historically, the REIT market has penalized such REITs that didn't have a clear specialization with a lower valuation multiple. And I fear that if Realty Income keeps going down that path, eventually it's going to hurt its market sentiment. It's going to result in a lower valuation multiple, leading to even more losses. It's also going to hurt its cost of capital even further and reduce its future growth prospects. My fourth argument for selling Realty Income is that today it's not able to grow accretively by raising new equity and reinvesting it at a positive spread. Dividend Bull here argues that this is not a major concern because it should be just a temporary problem, and as interest rates return to lower levels, Realty Income should regain a lower cost of capital, which will allow it to keep growing externally by acquiring additional properties. That may be true, but the fact still is that Realty Income today is struggling to grow externally because of its high cost of capital, whereas some of its close peers are still able to grow externally. Essential Properties Realty Trust is a good example. Its weighted average cost of capital is today around 6.5%. It's able to buy properties at an 8% cap rate, so there's still a nice spread for some of Realty Income's peers, and so it's clearly at a disadvantage, and this should result in lower returns going forward. And then my final and perhaps most important reason for selling Realty Income was that I believe that some of its close peers are today offering higher potential returns with lower risks, and therefore I just don't see the point of owning Realty Income. A great example here is Realty. In my opinion, it owns higher quality assets. It also has lower leverage. It doesn't have the size issue. It has a very good track record. It's been massively outperforming Realty Income over the past 10 years, ever since its size became an issue. And I just don't see any reason why this would change anytime soon. The valuations of both companies are fairly similar if you adjust for Realty's higher portfolio quality and lower leverage. And so in short, Realty essentially offers you higher returns with lower risk. And so why would you buy Realty Income? Here, Dividend Bull doesn't seem to have a really good counterpoint. He's simply saying that, yes, he agrees that Realty is a very good company, but he doesn't view this as a reason for selling Realty Income. But yeah, I simply disagree. You know, my capital is limited. Your capital is probably limited. If you're buying individual REITs or individual stocks, it's probably because your goal is to outperform sector averages. Otherwise, you will simply buy an ETF that includes everything. And so this implies that you're going to be selective. You're going to try to get the best risk to reward for your money, and in this case, in my opinion, Realty Income isn't offering the best risk to reward, and so why would you own it when you could own a peer like Realty? And so these were my counterpoints to the counterpoint of Dividend Bull, and in short, I still think that my decision to sell Realty Income is valid. I think that those counterpoints offered by Dividend Bull were not strong enough really to change my opinion, but the great thing here is that you get to hear two different perspectives. You have the perspective that's bullish from Dividend Bull, and here you have mine that's a bit more pessimistic concerning Realty Income. But note here that at no point did I say that Realty Income is going to cut its dividend, that it's going to crash, that it's going to go bankrupt, or that it's even going to perform poorly going forward. And I think that Realty Income is likely still going to deliver relatively attractive total returns. It's offering a 6% dividend yield. I don't think it's going to grow really fast, but even if you add 2% of growth, you get 8% annual total returns. That's relatively attractive. But my point here is that you can do better with some of its close peers that are even safer in my opinion. And so why would you settle down for Realty Income when you could potentially earn higher returns with lower risk with a REIT like Realty? That's the point I'm trying to make here, and I didn't really hear a good counter argument to that specific thesis in the video of Dividend Bull. Now, if you want to access my entire real money REIT portfolio, you can join High Yield Landlord, which is my REIT newsletter for a 2-week free trial. I'll put a link to it in the description of this video. Also, as I mentioned earlier in the video, I'm planning to reach out to the management teams of various net lease REITs to conduct interviews to give you even more context about all of this. So if you don't want to miss that out, make sure to subscribe. And then finally, if you enjoyed this video, I really appreciate it if you click the like button. That helps me a lot to grow this channel. Thank you so much in advance. See you at my next one. Bye-bye.